course, joining us is Steve Brice, the Chief Investment Strategist at Standard Chartered. We're also being joined by Santosh Rao, the Head of Research and Partner at Manhattan Venture Partners. Good morning, gentlemen. Thank you so much for joining us here on The Market. Steve, I'll come to you first. The FOMC Meet Outcome, along expected lines. The market's already saying, will it even happen in November? But the news that's coming out of Asia, that's what's going to really uplift the mood, what we're seeing with the Evergrande crisis. Your thoughts?
Yeah, clearly some good news. I mean, there's still a lot of uncertainty around the situation here. So obviously, the local bond payment is expected now to be made, but the dollar-denominated debt servicing costs of over 80 million today, and then another 50 next week, is obviously still up in the air. So I think that's still something that's overhanging a bit in terms of sentiment. So today it's obviously going to be a crucial day, but in reality there's usually a sort of a 30-day period after a bond payment needs to be made, sort of a grace period. So whether we'll get firm indications today of what's going to happen, it's not clear. But so that's still overhanging the market to some degree. But as you mentioned, stock prices up over 20%. So from extreme depressed levels, things look a bit better. Our view is the best way to play this is through Asia high yield, not through the equity market. Yields there are extremely attractive in an international context and relative to high yield elsewhere in the world. So that's our preferred route to play this situation rather than through stocks themselves.
Right. Santosh Rao, hi, good morning. You think a November taper deadline is something that the markets were already working with, and which is why no surprise on Wall Street, I guess?
Absolutely. I think there were no real surprises, like you said. But I think the market expected that. It's really the commentary that people were waiting for. And we did see that the Fed is leaning hawkish, little more than before. We saw 9 out of the 9 Fed officials leaning towards raising it next year and starting tapering. So I think that's good. I think market needed some kind of timeline, some visibility, and that helped. And you saw this relief rally, you can call it. I don't know if it is. Is it sustainable? We'll wait and see. But overall, I think there was no surprise, and that was a good thing. And the knock-on effect of Evergrande, that also was contained. So that's good. So kind of all that played into the sentiment today, which is net positive at this point. So I think net good, no surprises, good visibility, and the substantial progress that the Fed chair was talking about all this time. Nobody knew what it meant and how far. I think he kind of clarified that we're almost there. The benchmarks that he had set have been met pretty much in terms of inflation and employment. So he's pretty much all set to announce next in November and start tapering early next year.
Santosh, many fear, as was the commentary put forth by Jerome Powell as well, that inflation continues to be a risk and will respond with tools as and when necessary, and there are risks to the economic outlook which still persist. While COVID is a situation we don't have a handle on, but let's talk about inflation, because that across the globe has been in a worry wherein inflation has been inching higher. What tools do you think central bankers across the globe could take to measure down inflation? And would it have to be rate hikes?
Yeah, down the road, I think at this point, the chairman still feels that it's transitory. It's in certain sectors where the supply bottlenecks. So he thinks it can go away. I think he raised the estimates from a few points in terms of inflation this year and next year. But overall, 2% is his benchmark, and he thinks overall in the next 2-3 years, it'll hover around 2%, and he's fine with that. And he had the rate increase is the way to go about it. And that's not until 2023, looks like, at the earliest. He may pull it up slightly, but at this point, it doesn't look like it's going to be before 2023. And that's the biggest way he can do it. But he feels that it's transitory and it should settle at a reasonable level, at his 2% level that he's talking about.
Okay, gentlemen, we're going to leave it at that. Thanks so much for joining us live to talk about the kind of global cues we're likely to see for our markets. It's been a big week as far as decisions of central banks also go.